The next topic I'm going to be going over today is why the stock market is not the economy. So it's a really common colloquialism for people to say the economy is great. Look at the stock market. And this was definitely true in January before, it all fell down for a little while. And, this is true for lay people and for some politicians if it's in their interest to believe this. However, it's really important to keep in mind that the stock market is not the economy, because when we're investors, we need to have a nuanced view of what we're looking at. And, recently we've really seen this come true. We've had massive unemployment, increasing income inequality, and, without a rent without a rent and eviction moratorium, we would have record evictions right now, because of the economy shutdowns. And that's really important to keep in mind. Because despite this, the stock market is still doing relatively well. Right now, at least today, we are only about 5% from all-time highs, which is insane, in my personal opinion, given the outlook. But we're going to look at the specific reasons why. So right now, there are three main reasons that I think the stock market is as high as it is. Number one, and the primary reason, is the Fed. So the Federal Reserve is the banker of last resort. For anyone that's not familiar, I did a video on it a couple weeks ago. Check it out. It's on COVID, the stimulus, and the Fed's reaction. So check that out if you want a more thorough breakdown. But basically, they control the interest rates in the United States, which affects the price that banks are able to borrow money at. And that, of course, trickles down to what we're able to borrow money for. And lower interest rates mean lower asset prices when you go to get a loan, and that makes people buy more, generally speaking. So they lowered interest rates almost to zero, and that increases the amount of people buying homes, even though there are going to be, of course, people that are getting less money right now, which would suggest that you'd have less people buying. We've seen more people buying homes because they're able to get them with lower interest rates, which saves them a lot of money on something with that much of a principal cost. And we also saw a ton of people refinancing their mortgages, which still helps stimulate the economy. So both of those have helped pump up asset prices, specifically in real estate. And then there's not really anywhere else to put money, because right now we have historically low bond yields, which bonds and stocks are usually the two areas that most investors, since real estate can be prohibitively expensive, look at. And generally speaking, when stocks do poorly, you want to be in bonds. And when bonds, are normal and times are good, you want to be in stocks. And right now, bonds aren't yielding much. So most institutional investors are not going as heavy in bonds as they normally would. And that means that they're going to put more money into stocks and real estate, other main asset classes outside of commodities like gold, silver, etc. And then you can't ignore Jerome Powell with his money printer and the liquidity that gives. And basically the Fed was using that. One, it gets more money into the economy, which there's more money in the economy, then more people are spending money. If more people are spending money, then that's going to increase asset prices because there's more money going into those assets. But also that increased liquidity was also used to buy underlying bonds by the Fed and even ETFs. And so that directly increases those prices, which helps prop up the market. Reason number two is that the people, with money, like I said, they don't have anywhere else to put it, and they absolutely don't want to hold cash, because right now, due to that printing of money, we're likely going to have higher than average inflation. And normally inflation eats away about 2% per year of any cash that you're holding. It could be, it could be the same if QE works as well as it should, but most likely it will be higher. And higher inflation, well, one, pushes up asset prices because it artificially inflates their nominal value as opposed to their real value. And so that means it's more advantageous to be in those asset classes, whether that's real estate or stocks. And it doesn't make sense to hold cash because it means your cash is getting even smaller than it would normally. And reason number three is speculation. And this is definitely the smallest of the reasons, because the reality is that lay people are not the people moving the market. Generally speaking, it's investment firms and big buyers. It's not independent people, retail investors. However, there's a lot of newbies in the market, with Robinhood, Webull, and other brokerages going to zero commissions, and these app-based brokerages, and what I would call gamification of investing, where it seems very easy and accessible to the average person, makes a lot of people feel very confident in the market, and so they get started. And then you see a lot of them start immediately jump towards, say, using leverage or using like margins, which I talked about last week with leveraged ETFs as an example, or they want to place bets on very risky companies because they're not looking at valuations because they don't have the experience. And that leads to something else I talked about last week, which is greater fools investing. And essentially, this is why you see things like when Tesla's doing well, which up until recently, before its stock split, was, up above $1,500 a share. That's prohibitively expensive for most people. And so if I'm a newbie with, say, $3,000 or even $5,000, I probably am not going to want to spend all of that on 2 or 3 shares of Tesla. But what I would maybe do instead is look at, what other EVs are around and how can I get in on the action, so to speak. And I think this is why you saw a lot of like NIO, Workhorse, Hyliion, you saw these get pumped up like crazy just because Tesla did. And there wasn't much of a reason for that. And that's why you're seeing them come back down to earth, in my opinion. And that's something to keep in mind too, because that definitely is a big problem, is seeing things like, and the most egregious was Hertz, where Hertz files for bankruptcy and then their stock shoots up several 100% following that, which is absolutely insane, and was clearly, people that were newbies and not looking at valuations of companies, which is basically gambling. So, yeah. So that definitely is not helping. It's important. That's why it's really important for investors to start off, very tempered in like understanding what is an expected return, like what's reasonable and what's not. And that way they don't get taken for a ride on some of these things. So now we understand those 3 things that I think are propping up the economy right now, or the market rather, to make the economy look good. Now let's look at what is the relationship between the stock market and the economy, because right now I've only been talking about the stock market. So the economy as a whole, right, is not the stock market, but the stock market is essentially like a measure of the sentiment of investors around the future of the economy. So I think it's important to remember that investors only make up about 50%, 55, I believe, of the, like only that many people. So not the entire, population of the United States. It's only about half of them that are even moving this. And so, if investors think that a particular stock or asset class is going to do better in the future than its current price indicates, then they'll buy it. And when they buy it, this moves the price up, and that shows confidence in the future. You expand this across the rest of the market, and, if people are doing this across like on a macro trend, then macro just meaning large scale, then the market is going to go up because of increased buying. So that's why the stock market would go up. So if the stock market is up, there are multiple possible reasons for this, and we just need to remember to approach these, topics with a greater level of nuance. So like I was saying, about 55% of Americans own stock. And so it's important to remember who's gaining, like when we're talking about the economy and the stock market, because again, 55% of people are gaining when the stock market goes up. The other 45 aren't really seeing anything directly from that. They may have some, small benefits, inherently that, are not increasing their actual net worth, but directly only about 55% of Americans are seeing that. And most of the 55%, these are in retirement plans. These are not active stock traders. So these are people, generally speaking, just buying the S&P index. They're not really placing bets, so to speak. They're just trying to follow the main, the biggest companies in the market and follow the market as a whole. So the people that are really moving the market, it's mostly those big investment firms. And it's important to remember when we're looking at, okay, so why? So then what would be like, why is it that these people aren't investing, right? Like, why is half the economy missing out and therefore unrepresented in the stock market? You got to remember that in order to be able to invest responsibly, that's the important thing to keep in mind. In order to be able to invest responsibly, technically, you could take out a loan and invest it all on Bitcoin if you wanted to. But, there are at least three things that you have to do first. Okay. The first is to cover the cost of living, right? Housing, food, other necessities, right? Second is, and this is an opinion, is to pay down high interest debt. Because low interest debt, you can at least worry about a little bit later. If it's, lower than about 3 or 4%, generally speaking, you're probably better off getting an emergency fund first, but that can go either way. It just depends on what type of, percentage you're getting. And I have some links below to some good high interest savings accounts. So be sure to check those out. But my opinion, I would pay high interest debt down first, but that's just me. But some people will put these two reversed. But my third would be save a 3 to 6 month emergency fund. And this is because look at right now, if you were someone in March that had a job that went away, or you, like a lot of people in the airline industry, got furloughed at the beginning of this month, you're definitely going to want to have 3 to 6 months of those costs of living set aside, because that way you don't have to get high interest short-term debt in order to make it by. And then once you've done those three things, then you can start investing. Because up until then, in my opinion, you probably shouldn't. It's not a very safe thing to do, because it could bite you pretty hard. And so it's important to remember that for many Americans, like, they can't achieve these goals. Or if they can't, then that means that the market does little to help them. And that's the primary disconnect between conflating the market with the economy. And that's why when, especially when politicians do it, it's very disingenuous. So the main takeaway here is that for you as an individual is to make sure that you save so you can invest, and that way you actually benefit from the market increases. Because if you can, you need to be. There's no reason not to. And then you need to remember that investing requires, a nuanced view of the economy, both micro and macro. So individual stocks and the economy, overall. And also, I think it's really important to call people out when they spread these types of myths. Similar to the minimum wage ones, we need to keep, people grounded in reality and make sure that we are holding especially politicians accountable, but ourselves and, anyone that's talking about this stuff, myself included. So let me know if I'm full of it. If you enjoyed this clip, be sure to leave a like, subscribe, and check out the full live version of the Wealth for 99 podcast, where we talk finance, economics, and public policy from a working class perspective. We'll see you there.